Welcome to my Counting 1110 review for final Chapter 9. Wahoo! We're on the last one. Chapter 9 is a big chapter, and it covers several topics. In fact, it covers all the remaining current assets on the balance sheet that haven't been talked about yet, and tucks in a few other topics as well. It covers credit card sales, direct write-off method of accounting for bad debts, allowance method of accounting for bad debts, notes receivable of a short-term nature, and any related financial statement analysis ratios that relate to these topics. We're almost through, so hang in there, and I'll make this as fast as reason dictates it should be. Let's move right into credit card sales, shall we? Lots of companies have taken to using credit cards to do their credit sales. It's a really nice way to grant credit without incurring all of the negative expenses associated. You don't have to do credit checks. You don't have to suffer bad debt expense. You don't have to send out statements and do all of those things. All you have to do is pay a service charge to a credit card company, and you are good to go. There are really two basic ways credit card sales can take place. Let's do an example. We'll assume that you sell $100 worth of merchandise to someone who has a credit card, and the credit card company charges you 3%. In one direction, you get immediate cash in the amount of $97. You record the sale for $300. Oop, how about $100? Can't do my own math, huh? And you pick up the credit card expense for $3, and you immediately get the $97 in your checking account, and you pay your fee. This works well when the credit card expense is known up front. Another way that this can happen is you can get credit for the whole sale, and then during the course of the month you have many of these, and at the end of the month the credit card company expects you to remit based on your sales volume usually. So you would send them some money, in our case $3, because we only had our one sale, and you pick up your credit card expense and send them a fee. I think this first method is the most popular, but notice what you get out of accepting credit card sales. You get your cash immediately, and for a paltry 3%, you don't have to run credit checks, send out statements, or do any of the other things that are so costly as they relate to accounts receivable. Oh, there you go. We knocked off credit card sales. Just like that. I also want to look at the direct write-off method on this pincast. We'll keep it short, under 10 minutes, I'm hoping, but let's do that. I'm going to turn the page. Let's begin the discussion of bad debts. Why would you sell on credit if you know you're going to have bad debts? And the answer is you think you're going to have more sales once you take away the bad debt expense than you would if you didn't sell on credit. So it's kind of a necessary evil. You know they will happen, but you're accepting this and probably build it into your pricing structure, which means you got it. You and I end up paying for people who don't pay for their accounts. There are two ways that you can calculate bad debt expense. One of these methods is called the direct write-off method, and the other method is called the allowance method. The direct write-off method is simple and it's fast, but it's only allowed for small companies to use that are private, not public. And the reason for this is poor matching. You're not going to write off a bad debt immediately. You're going to do a lot of collection effort. And so what happens is, in the direct write-off method, that the sale gets picked up in one accounting period and the write-off gets mismatched and picked up in another. Under the direct write-off method, you write off directly to accounts receivable, and that's where it gets its name. Here's an entry to write off an account. You would debit bad debt expense, and like the name says, goes directly there from accounts receivable. So the write-off happens directly from the accounts receivable, and it gets its name from that, directly from accounts receivable into bad debt. When you recognize that this probably happens in a period after the sale was recorded, you can see that it in fact has very poor matching. It is allowed for small companies, they're not public. Let's take a little bit of a look at the allowance method now. It's a little more complicated because you have to estimate what your bad debts will be based on some measure. And you don't really know what that is, but as a general rule, you can base it on past experience. Companies of any size can use this method. And it is required to be used by public companies. Of the two methods, it probably is used by, well, I can't say by more because there's a lot of really small companies. What happens is an allowance account is set up estimating what you think future bad debts will be, and this account is set up timely so that it has good matching. So we're going to set up an amount to anticipate bad debt expense, guess what it's going to be, and book it before we actually know. To make the entry to record the expense, you're then doing it in the same period that the sale happened. So it's great matching. You don't know who or where or when, so you can't go directly to accounts receivable. You set up an entry that says bad debt expense, and you credit the allowance account, the allowance for bad debt expense. Just like the name suggests, under the allowance method, bad debt expense is taken to the allowance account, not directly to the accounts receivable. You can't go to accounts receivable because it hasn't happened yet. You're just estimating what it will be. The allowance for doubtful accounts is a contra account. So now on our balance sheet, if you use the allowance method, you'll have the accounts receivable having the amount that you are owed by your customers, and then allowance for bad debt expense being subtracted from that, leaving you the difference. We call that net realizable value. It doesn't really say that on the balance sheet, but that is the name, and that's how much you expect to collect. We'll come back to that several times in the future. And notice we went to an allowance account, which is a contra account. It's contra to accounts receivable, and it adjusts accounts receivable to a more accurate balance. Think of it as you might think of accumulated depreciation, and then you have an idea of how that entry works. When the time comes to actually write off a bad debt, you know who, you know what, where, and when. You don't go to bad debt expense. It's already been accommodated. You go to the allowance account. So you debit the allowance for bad debt expense, and you credit accounts receivable. You know who and when now, and you can take it out of its temporary holding place, the allowance account, and apply it directly to the accounts receivable. The next pencast is going to examine the allowance method in great detail. So, we knocked off a couple of our list. We knocked off our credit cards and our direct write-off method. We have allowance method, notes receivable, and financial analysis still to go. Thanks for joining me in part 1.